Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Shall we say it's been an interesting week?
That's the politest way to say it, but as we know, there's that Chinese curse, may you live in interesting times. And
oh, yeah, I had not thought of that one, but yes, indeed.
Bob, we'll start off the show by answering listener questions. We have 3 today from Chris, Mike, and Ernie. First off from Chris. Hello, Bob. Thank you for sharing all your work with us. Your depth of understanding is remarkable. My question relates to the current market climate. I've noticed that bond prices may have reached their bull market peak with a rare DSI of 98. What is DSI, by the way, Bob?
Oh, that's a relative strength indicator.
Also, the liquidity must be extremely tight based on unbelievable repo activity. Seems to me that all bond prices, even short-term bond prices, have only one direction they can go, which is down. Are we on the cusp of the interest rate shock that you allude because of forced selling of highly liquid bonds? Also, could a global bond revulsion actually cause a global capital flight to U.S. dollar-based equities? Now Mr. Margin has wrung out some leverage in the last 3 weeks. There is no place safe except cash, gold, and eventually gold stocks. Thank you, Chris.
Hey, Chris, that's a good long question, but I was just thinking the other day that when the favorite items rolled over, stocks, lower grade bonds, commodities, industrial commodities, you went to they call the safe haven story, which was focused on the long treasury and gold. And so, and the irony is that in an instant, the safe haven position becomes over speculated, so to speak. So then, yes, the long treasury is way up there, hugely speculative, and I believe quite vulnerable. And this time the hits got the HYG, high yield J and K junk, and even the MUB or the EMB, the emerging bond debts, which has been bulletproof. But the most incredible thing the other day is while there was a strong bid for the long treasury, the MUB, the municipal bond index, got trashed. And most of the time, the MUB trades up and down with the bond future. So all of a sudden, you've had risk come into the municipal bond market. And while we may not be playing this ourselves, it's important because any of the Democrat-run cities, towns, or counties that are going to have been mismanaged and have huge pension obligations. So there is a real risk in the municipal bond market. And it finally came out, so that was interesting. And yes, on the overall bond market, I think it can go to what I've been talking about as the bond revulsion, because some people, at least in December, January, were thinking that, hey, inflation's back, the dollar's going to go down, and commodities are going to go up, and silver's going to fly. All that stuff came out. And then the next step on that one was to then say that, well, interest rates are going to go up. But that's not the way it works after a financial bubble. What happens in the financial bubble is the world takes on a huge amount of debt, and then it has problems servicing it. So it's not, the threat to the bond market is not a return of price inflation. It is the next step after a great bubble, which is price deflation, so that tax revenues decline, corporate revenues decline, and it becomes impossible to service the debt that was so recklessly taken on during the bubble. But, Chris, it was a good question. Thanks. Oh, it says gold stocks. Yeah, they are vulnerable to the hit in the big stock market. But out of the storm, the gold stocks will then become the next really consistently big performer.
From Mike in Burbank, Bob, why is the U.S. dollar being aggressively sold while at the same time there's a flight to safety into U.S. treasuries? This seems counterintuitive. Also, will we see the S&P at 2,000 again? Judging from the rate of the current market decline, the S&P descending to 2,000 seems like just a stone's throw away.
Yeah. Yeah. In the first hit, the U.S. dollar was bid up, and then it got overbought on the daily, and then it corrected. So it's in choppy weather here, but the course of the U.S. dollar, and actually it's the course of the senior currency in the post-bubble environment, is that it typically becomes chronically strong relative to most other currencies and most other commodities. Of course, this is what happens in the deflation, is that the purchasing power of the senior currency goes up. And the part of that is driven by the fact that a huge percentage of the debt written in the bubble is underwritten in the financial capital, which is New York, and due and payable in U.S. dollars into New York. So effectively, the debt bubble is a short of the dollar, and in which case it's a massive short position in dollars. So it's going to be interesting to see how it goes. And the hit of the stock markets, we had a target that Ross has been publishing every once in a while for the last 3 or 4 months, and that was that on the lengthy bull markets like those that run 9 or 10 years, and you take the low when it started and then the high, and then typically to 1987 or the 1960s, any of these decade-long bull markets, the first hit was a 38% retracement, and with looking at the S&P, the Dow, or as I follow the New York Stock Exchange comp, we got into that territory yesterday, and with enough oversolds that we're getting a bounce in here too. And then same thing with crude and the oil patch. Everything got trashed so hard. And then, Jim, this is where it's fascinating for me, even as an old-time market analyst, that it's fear and greed on the big events that really drives things, and you've got collectively how many people involved in the financial markets that expressed huge euphoria in January, and bang, goes the other way to complete and utter dismay at close to a 38% retracement. So there'll be some bounces in here, but for traders, we would wait until you've got a tested low in place, and then there could be, a 5 or 6 week rally, that sort of thing. But this is extremely dangerous financial markets, and we'll leave the trading to experts on trading desks, although our work, I was used, of course, by a trading desk, so it's been fascinating to watch it.
And our final question today from Ernie. It's becoming increasingly obvious that governments are going to have to monetize their debts. Most of the stimulus has gone into equity markets. Would monetization inflate general prices, or would doing so keep equity markets at higher levels than normal, or both?
Right, Ernie. It's getting cause and effect backwards. Even the Austrians with the Mises, people von Mises, they figure that booms are caused by central banks issuing credit. But then booms collapse and then nothing happens. So the view I have is that a boom allows a central bank to be reckless, because you've got to have somebody to borrow the money out there at the ultimate end of it all. And then also it's the public that chooses what will be speculated in. And in one decade, it was commodities. And then the next decade, it mystically transforms over speculating in financial assets. And then when financial assets blow out, which seems to be the case in January, it's followed by a severe contraction, and often it can be a lengthy contraction. So it's the public that runs the markets, not the central bankers. And with what happens after, well, it's simple. Long economic expansion, which we had, then a burst of price inflation, crash. Then out of that comes an era of speculation in financial assets, then crash, which we may be getting now, and then a lengthy contraction. So these forces will overwhelm the Fed's desperate attempts to try and reflate the bubble. So good question, but it's going at it from the other direction. It's what the markets will do to the central banks will be the issue, not what the central banks can do to the markets.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, you've gone through some interesting headlines for today's show. The first headline, financial conditions tighten at fastest pace since the Lehman failure. I thought my question is, they lower interest rates with the idea that will stimulate the economy, but banks become reluctant to lend that money because they think it's risky. Is that really what the case is?
That's what it's all about. And here's the fascinating thing, is that it's the market it's the credit market that's tightening credit, not the central bank. And the other thing is that this myth that you get an elevated stock market and people get a little nervous, you see some strains coming in the credit markets, and then the pitch has been that, the Fed is going to cut its interest rates and that'll extend the bull market. But it is very simple, Jim. Short-dated market rates of interest like Treasury bills go up in the boom, and then in anticipating that the boom is ending, the T-bill rate starts down. And then, typically 5 to 6 months later, the Fed then lowers its rate. So the idea that the boom can be kept going by the Fed cutting rates has been absolute nonsense because, oh, God, I can show you hundreds of years of data where a money market rate will go up in the boom and down in the contraction, down in the bust. And as a matter of fact, there's even more irony to it because the faster the stock market's going down, the faster the short rates have come down. And this is where, like now, the Fed did a 50 basis point cut because the T-bill rate had fallen by, something like 65 beeps. And the reason why the T-bill rate came down is because the markets got nervous and the serious money goes to the most liquid items, which is U.S. Treasury bills. So the market forced the rate down and the Fed had to follow. So that's fascinating, but I can't believe how so many people in economics really consider that they can keep a boom going by lowering risk rates when indeed what happens is that the boom crashes and interest rates crash as well. I love it.
Well, if low interest rates propelled an economy, Japan and Europe should be booming right now because they have zero and negative interest rates.
That's right. Yeah, but it ain't happening. So you got the business cycle is changing. And here's the other item in this, Jim, is that...
Well, Bob, we'll get to the next item right after this important message.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, an interesting headline you saw today. The U.S. economy dangerously dependent on Wall Street whims.
Yeah, that one was from the Financial Times, and the headline states the story, dangerously dependent, but the headline writer put in whims. Man, Wall Street doesn't work on whims. It works on market forces. But in the old world, the stock market would go up on a cyclical basis, and the economy would, and then the stock market would peak about 10 to 12 months before the economy peaked. And, of course, this is then why they put the S&P in their leading indicators. But the world changed when you get into financial asset inflation. And the financial markets become so big relative to the economy that when the market turns down, the economy turns with it. And the evidence on that was that the 2007 was a pretty good bubble. And it peaked in the middle of October, and the economy peaked in December. That's only a few months. Going back to 1929, the stock market peaked in September, and the economy peaked in August. And then the previous bubble, where you do have the U.S. business cycle, was the bubble that peaked in September of 1873, and on that one, the economy peaked in October, and then you went into severe contractions on those. So, I would think that the economy will decline very quickly, and then also it's made worse by the panic with the coronavirus. So, there's two things going on here, but the economy will head south fast with the stock market.
Bob, another question that we have, and it's for me. The U.S. Fed says it's going to a range, $1 trillion in short-term loans over the next couple of months. Will that make any difference here? Will that just be wasted money?
It just wasted money. For example, in 1929, the Fed knew that it would provide liquidity and prevent the crisis, and that would prevent a recession. So, during the crash in 1929, with George Harrison, who was the president of the New York Fed, and he bought bonds out of the market and pushing in short-term liquidity, and he exceeded his lending authority by a factor of 6 times, and it didn't work. And even then, you go as late as July 1932, which was an important low, and Barron's, the important financial newspaper, had an editorial, and it pointed out that every anti-deflationary measure taken by the Federal Reserve has not worked. So the evidence is that in 1929, the Fed was accommodative, eased, of course, interest rate went down, but, and yet economists beginning in the 1960s looked back on the Fed in 1929 and said that it tightened deliberately. And also even Milton Friedman said that. So, the market tightens on its own, and these are just the Fed and its repos and stuffing cash into the market. It's just a bureaucratic ritual.
Bob, thank you so much for chatting with us.
Jim, good to be with you, and I look forward to next week.
And a reminder to our listeners, Bob does answer your questions. You can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.